Hey everyone, I'm going to share with you today the 3 dividend stocks that I am buying right now in June and July of 2020. These are 3 stocks that I love, and quite frankly, I'm not only adding to these positions, but philosophically speaking, if I were starting over again, hypothetically, if I were starting over my dividend stock investing, I would feel comfortable just building a portfolio around these 3 stocks. Yes, the stock market has gone up a lot. Yes, the stock market seems a little bit disconnected from the reality that we face now with this global pandemic, with a shaky economy. That being said, I am a long-term investor. I am looking many decades out into the future, and I am investing for dividends and cash flow. So I feel so good buying these 3 stocks right now. I'm going to go into them. I'm going to go into PepsiCo. I'm going to go into Starbucks, and I'm going to go into 3M. I'm going to go into each of those in depth. And I especially am looking forward to going into Starbucks. I want to analyze their balance sheet because so many of you have been asking me, Ian, why do you invest in Starbucks even though the balance sheet is no good? They are carrying negative shareholders' equity. Well, I want to go into the balance sheet today and show you all why I think it is deceptive, and I actually think their balance sheet is just fine. I continue to buy more shares. I love Starbucks, and I feel that their balance sheet is just fine. So today's video is going to be really exciting. I'm going to share these 3 stock picks that I am buying right now, and I'm also going to back it up with the financial analysis. Get ready, everyone. Another dividend investing video. All right, everyone. So I'm going to start with PepsiCo today. I'm excited to start with this stock in particular because I bought more shares recently. This is the first time that I bought PepsiCo in a while. And long story short, one of the main reasons that I started buying PepsiCo again is I just had this epiphany. It's my number 2 favorite stock of all time, and I need to show it more love. It is not where it needs to be in the portfolio. It's not at the target allocation, and it is such a premium, high-quality company. They're doing so many things right. They are taking more of a direct-to-consumer approach, if you will. I like what they're doing on the disruptive technology side. They just launched snacks.com, for example. And so there's so much I love about PepsiCo, but I haven't been showing it the love through my money. I haven't been allocating money to it, and I need to because it's my number 2 favorite stock of all time, and it just kind of got forgotten about. I hadn't been buying more shares for a while. And so I want to share on the screen right now a snapshot of the financials with PepsiCo and also the rationale why I am purchasing this great dividend stock right now. So check it out. And what you see here is the recent trade date. I recently bought some more PepsiCo on the 17th of June, and I will continue to buy this stock into July. This is going to be a focus of mine for July. I bought it $132 and change. The dividend per year is $4.09, and the dividend yield is just over 3%. Keep in mind, this is one of the reasons that I like PepsiCo right now in this frothy stock market, that I believe, quite frankly, one of the reasons that stocks are surging, especially quality stocks like PepsiCo, is because of all of the stimulus that is hitting the economy through the federal government and through the Federal Reserve. All of these trillions and trillions of dollars, I think the stock market is pricing that in. I think the stock market is pricing in inflation. I think the stock market is pricing in a dollar that will eventually be devalued. And so what makes more sense to invest in? A dollar that is potentially eroding in value, or a world-class company like PepsiCo that has pricing power? And so I think that's a little bit of what's happening in the market now. And to get a 3+% yield on one of the premier companies in the entire world on a starting yield basis in this kind of weird universe we live in right now, that's one of my favorite things about PepsiCo. And so moving on, What else is interesting is their EPS estimates are solid. 2020, they're going to earn over $5.32. 2021, $5.88. And so this puts the current PE or forward PE for the current year at about a 24.97. Next year, 22.59. I'm not going to kid you or kid myself. This is fairly priced, but I am paying up for quality. It is a core stock. It is a quality stock. And what these numbers show, these robust earnings per share numbers show, is that this company is doing all right despite the global pandemic, despite the economic concerns and devastation that is being unfortunately faced. And so this is the kind of stock that I want to own that does well in all different kinds of environments. And so moving on, what you see next is the payout ratio. If I take the earnings, if I take the dividend per share, which is $4.09, and I divide that by the expected earnings for 2020, I get a payout ratio of 77%. And if I do the same for 2021, I get a payout ratio of 70%. And so payout ratio is fine. They can cover the dividend with their earnings. And so I feel just fine about that. Now get this. Shout out if you've been here since the early days when I was doing the videos in my backyard. I was doing the outside videos, but I did a series of videos back then about hypothetically how I would start over. If I were starting over again, what would I do? And one of my golden rules of dividend investing is picking stocks, selecting stocks that in perpetuity tend to raise the dividend about 7% per year on average. And so with PepsiCo, over the last 5 years of data, they have raised their dividend on average each year by 7.8%. And the way that I get that is depicted in the formula that you see on the screen right now. I show the formula there so you're able to calculate this at home, and I'm comparing the quarterly dividend from 2020 versus 2015 to get that growth rate. And so that is why I highlight 7.8%. This is why this is my number 2 favorite stock of all time, is I do generally believe that PepsiCo will be able on average to continue to grow the dividend roughly 7% per year in perpetuity. And that is something that attracts me to this stock, because even though the starting yield is 3%, which in its own right is really wonderful, growing that dividend over time at 7% or more does wonders for my future cash flow that I will use to pay bills. And I already am paying some bills with cash flow, but I will need a lot more cash flow in the future when dividends pay all of my bills. And so on the right side of the screen right now, check it out. You can also see some of the reasons I'm buying, and I have already discussed some of these reasons. It's my number 2 favorite stock. I lost sight of the position, and I've been spending so much time buying other positions. This is why I have a renewed focus right now on my core stocks and my quality stocks, because this is kind of a challenge that happens when you have a more mature portfolio like I do. I've been investing for over 20 years. I've amassed larger positions, and PepsiCo, it is a very large position within my portfolio, and because of that, I kind of lost sight of it. But the takeaway here is just because a position is already large does not mean it should be forgotten. It does not mean that I should neglect it. It does not mean that I should lose sight of it. And so, yeah, PepsiCo, it's already a massive position in the portfolio, but I want it to be even bigger. And so that's why I have a renewed focus. And you can see here, my current allocation, I have 5.58% of my money in PepsiCo, roughly speaking, and I want to allocate this up at 7%. And so I have a long way to go. I would be happy having it at 10%, and I'd much rather have 10% in Pepsi than the 5.58% I have now. And so with my favorite stocks, my core stocks, I would like to be either at my target allocation or above the target allocation. And so, by the way, if you want to see all my target allocations, you want to see all of the dividend stocks that I own, I will link in the description below, and also the pinned comment below. I share my portfolio. You can go ahead and download my portfolio in Excel. Whole range of data and analysis in there. I have a video to accompany it. Check it out if you've not seen already. And so moving on, Also, I am very pleased with their performance during the pandemic. That is evident through these EPS estimates that we just talked about. I am very pleased with their direct to consumer initiatives. And I'll give you a fun fact. Way back in the day, in one of my early jobs, in fact, my first job out of college, I worked at a tech company. And this was a tech startup that eventually grew quite a bit and got bought out by private equity. And at that company that I worked at, there was I don't remember his exact title, but I think he was either the CTO or the basically in charge of all the engineering, and I have a lot of respect for him. I felt that he was a very good leader and a very solid engineer. Well, it just so happens that now he is working at PepsiCo, and so I've seen some of his updates on LinkedIn, and that alone gives me confidence when I see someone, a Silicon Valley native, someone who lives and breathes technology, that knows technology the right way, the way it's done here in the Bay Area, and is brought on board to a company, and a quote-unquote old world company that I own like PepsiCo. I see those kind of things, and it just inspires confidence. A lot of confidence that gave me in PepsiCo, in their hiring processes, and that they're bringing the right talent on board. And so that gives me so much confidence in this company. I like it that it's a consumer staple. That's the bread and butter of what I like to invest in. Quality always wins. Hey, I'm paying up for quality. But quality always wins with me. And I'll tell you, hey, if the market tanks again and this stock tumbles, I will be buying all the way down, all the way back up. And so that does not scare me at all. And I know in the long run, 20 years out, whether I'm buying here at, say, $132, or let's say it tanks down to $90, I think I'll be happy with any of those tranches. And so I have a very long-term focus for my dividend investing. And last, I want to point out that you think of something like Pepsi, you think it's an iconic American business, and it is, but also worth noting it has international exposure, international diversification, with 42% of its business coming internationally. And so I love that about PepsiCo. I am sorry, Pepsi, that I forgot about you. I'm sorry that I haven't been adding more money to you in recent years other than reinvesting dividends. And I have bought some tranches here and there, but I want to take a renewed focus on PepsiCo for a while here in July and future months as well. Let's see how much money I can get into this thing. All right, Starbucks. So I want to move on to stock number 2. This is stock number 2 that I'm buying now in June. I'll be buying in July as well of 2020. And many of you know I buy Starbucks every Monday. It is a routine that I have that I love. It helps me start the week on the right note. It helps me basically just stay in the game, stay committed to dividend investing, have fun with it. But also, I'll tell you, sometimes goals can be daunting. I want my Starbucks position to be substantially larger than it is. To get from where I am now to where I need to go, it's kind of a daunting task. But if I take that task and I break it down into bite-sized chunks, and I do 1 brick a week on Monday each week, I just keep buying, I will eventually get to my goal, and it makes my goal less daunting. And so that is a hack that I use for dividend investing when I feel like it's a little bit overwhelming where I need to get. I'll just break it down into smaller chunks and just keep buying each week. And so check it out on the screen right now. I'm going to share Starbucks. Again, I'm going to share some statistics, and I'm also going to share why I am buying. And here's my recent tranche from this Monday. I bought on June 22nd at $75.39. The dividend per quarter is 41 cents. It is 164 per year. Starting yield is kind of low at 2.18. Worth noting, different stocks in my portfolio play different roles. PepsiCo, I would say it's probably more of a slow grower, but it's a core kind of rock solid company that it's like an anchor, if you will, on the portfolio. Starbucks, I look at it as a little bit higher volatility, much higher growth company. It's the growth in my portfolio. It's the high growth. It plays that role. And I like it because it supercharges my future income. The current dividend is not that high, but they are growing the dividend very quickly. And they will continue to, in my humble opinion, which gives my future self the opportunity to earn some truly, truly massive dividend income because of the miracle of yield on cost, which I've done a number of videos on, and I'll link in the description below to one of my early ones, one of my earliest videos if you want to check that out, a classic if you will. So moving on, what you see here is the analysts are estimating that this will be a horrible year at 99 cents earnings because of the pandemic, and they are estimating that in 2021 will be a little bit closer to normal at 264. And so I'm not going to sugarcoat it. The current PE for this year is a 76, and the forward PE for 2021 is a 28 and change. And so the payout ratio also is pretty horrible. They're not covering the dividend this year. The payout ratio is 166%, and it's 62% next year. So just fine next year. Long story short, I'm not going to sugarcoat it. There is risk with this company. The company is facing some challenges because of the pandemic. I think they are addressing them well, and I am taking a bet on the future. And I am buying at discounted prices, and I've been buying this whole range, these 50s, 60s, 70s. I've been buying this range because it is on discount, in my humble opinion. It's on discount because of what is going on with the company and with the economy and with this pandemic. And so that being said, I'm a long-term investor. I have a fundamental belief that a year, 2 years, 3 years from now, more or less, society will get back to normal at a certain point. And yes, we will continue to do things a little bit differently, but Starbucks has become a third place. It has become an essential comfort, if you will. It has become a break for many people from their job. And so I have a faith that this company will continue to thrive in the long term. And in the short term, I don't mind taking on a little risk and buying at discounted prices. So check this out. What you see next below this table is the compound annual growth rate at a 20.7%. That's right. On average, over the last 5 years, Starbucks has raised the dividend on average by 20.7% per year. This is what I like the most about it. This is why I consider it a growth position in my portfolio. And typically with growth comes a little bit more risk, as we just saw in some of these volatile numbers. I don't think this 20% will hold up in perpetuity, but I surely think they can beat my 7%. That is kind of my base case for a core favorite stock of mine. And so that's something that compels me and attracts me to this stock quite a bit. But don't get me wrong, this stock does have some risk. I'm willing to shoulder the risk because nothing is perfect. It is very rare. I mean, I guess maybe PepsiCo is perfect, but most companies out there, it's just not up and to the right. Along the way, along their journey, there's going to be some hiccups. There's going to be some challenges. It's how the companies deal with the challenges. And I think Starbucks is doing a fine job dealing with these crazy challenges that it is facing in 2020. So what are some reasons that I love this thing right now? I personally just love the coffee and the experience, and I know so many other people do too. The allocation's really low. I only have 2.5% of my money allocated to this thing, and I want to get to 6% or more. That's what I'm saying. It's a little bit daunting, but I also love that because it gives me something to focus on as a dividend investor. This is a technology company. Yes, it's a coffee company, but it's also a technology company. Their app, for example, processes an enormous amount of payments. They are very technology focused. They are very integrated in terms of mobile ordering, for example. This is a technology play, in my humble opinion, that comes through the lens of the restaurant, of the coffee industry. I love that. I like how they've treated their employees throughout this pandemic and this economic crisis. I think they've done a good job there. Coffee is just important. I'll tell you, these days, society is speeding up a bit. Everyone is working really hard. Everyone, is working long hours. It is a little bit more difficult, I would say, to live in modern times, probably than it was back in the 1990s, for example. I just know as a parent of 2 kids that I can't make it through the day without coffee. Coffee is something that powers our society. It's something that gives people a break. I think that premium coffee experience too has kind of become a fundamental necessity of many consumers out there. And so I like it just for the factor that I believe their iconic coffee is not going anywhere. And if you doubt me, just go to Starbucks sometime, or now it's in many places. Well, in my area, they've reopened the inside, but you cannot sit down there. But just go there and kind of see what's going on. Many of the customers are, they're kids, they're teenagers, it's younger people. And that's what gives me this confidence that they are approaching coffee as something so essential to their life. And I think that's something that's going to stick with future generations as they get older as well. So I think that is a macro trend that is really in favor of the Starbucks experience. And so moving on, I also just think they have room to grow internationally. They're 69% of their revenue is coming from the Americas. So there is some international exposure, but surely not enough. And I think there's opportunity to grow internationally. All right, so we're on the topic of Starbucks. I want to take this opportunity to answer a very, very popular subscriber question. And the subscriber question goes like this: Ian, how could you do it? How could you invest in Starbucks because their balance sheet is really bad? It's a bad balance sheet. They have negative shareholders' equity. What that means is the assets that they carry on their balance sheet are less than the liabilities. And so you take assets, you subtract out liabilities, there's nothing left. It is negative. And people look at that and they think that the company is not managed properly. And so I personally subscribe to a completely different theory. I think their balance sheet is just fine. I'm going to explain why. But before we even get into that, I want to challenge all of you out there who place a lot of emphasis on shareholders' equity in an industry like this, coffee, restaurants, to consider otherwise. Yes, shareholders' equity means a whole lot in the banking industry. It means a whole lot in the insurance industry. In certain other industries like consumer non-cyclical, consumer oriented industries, in my humble opinion, I don't know why so many people in this community place so much emphasis on shareholders' equity. If you're one of those people, comment in the comments below. I'd like to learn more where you're coming from, because I just don't get it. I don't get it. It's literally the last thing I look at. And so I want to start with the balance sheet. I'm just going to share it on the screen right now. I want to share the top part of the balance sheet, which has their assets. And so you see at Starbucks, first thing off the bat, this is their fiscal year. It's the year that ends at the end of September each year. And I use annual reports because I like to look at things annually. So I'm comparing 2018 versus 2019. And what you see off the bat, this arrow at the top, I drew that. Cash and cash equivalents drop. They drop substantially from 8.7 billion down to 2.6 billion. So off the bat, you see, okay, if shareholders' equity is negative, why is it negative? Well, one of the reasons it's negative is because their assets are down. Why are their assets down? Okay, there's less cash. And so we have to start looking, well, where did that cash go? We're going to look at that in some of the next screenshots. But while I'm still on this screenshot, you can see at the bottom that total assets have declined from 24 billion to 19 billion. And so moving on, I'm going to show another screenshot. Now I want to move down the balance sheet. I want to start looking at the liabilities section of the balance sheet. So check it out. And what you see here is this has liabilities and shareholders' equity. Again, I have some arrows on here. I made those arrows. Those don't come on the balance sheet. I put them there to draw attention. And the first thing I want to draw attention to is on the liabilities, there's something there called deferred revenue. And you can see from 2018, there was deferred revenue of 6.7 billion, about the same in 2019. And if you look above, actually, I should have drawn an arrow to it, but there's another line up there that says stored value card liability and current portion of deferred revenue. And that's a 1.6 billion in 2018, 1.2 billion in 2019. So if I add up the 1.2 billion and the 6.7 or so, I get about 8 billion. I have about $8 billion in deferred revenue. And what this means, to my understanding, is this is revenue. This is revenue that they have received for services they are to render. But because those services have not been rendered yet, they cannot count that revenue. They can't count it yet as actual revenue. And I guess the way it's accounted for, because of GAAP accounting, generally accepted accounting principles, is it must be counted as a liability on the balance sheet. And so if you're an accounting person, if you're a finance person, a CPA, share in the comments below your thoughts on deferred revenue. I'm not. I mean, I'm good at accounting. I'm great at it. I'm a financial analyst, but I am not as good as some of you at home. And so please share more details below. But my understanding here is this is one of the reasons that GAAP accounting sometimes is looked at as quite conservative. It's conservative because they're actually counting a liability here of revenue that is deferred. It's revenue that they are to receive in the future when the services are rendered in the future. And so it's deferred in that sense, and it's a liability on the balance sheet. But the question is it really a liability? Is it really? I don't know. And so it makes this alone makes the shareholders' equity go negative. And so look further on this screenshot right now, and you see at the bottom, I did a arrow to it. The shareholders' equity is a negative $6 billion in 2019, and if I had the $8 billion from above, from the deferred revenue and the stored value card and current portion of deferred revenue, if I had that $8 billion, it would cancel out the negative $6 billion, and all of a sudden they would have a positive shareholders' equity. And so far, just looking at the balance sheet, there's two things that pop out to me. One, cash is down. Why is cash down? I'll foreshadow. It's share buybacks. We're going to look at that in a minute, or at least a lot of it is share buybacks. So that hurts them a little bit. And the question becomes, is this really a bad balance sheet? Is it a horrible company because they use their cash to buy back stock? No. That's how many people look at it, though. And other people is this really a bad company? Oh, their shareholders' equity is negative because they have a huge $8 billion liability for deferred revenue. And that is growing. Deferred revenue will probably continue to grow because people are putting more and more money on the Starbucks app, for example. This is revenue that will be used in the future for services rendered in the future. Is it really a bad balance sheet because of that? No, it's a structural business model thing, in my humble opinion. And so, quite frankly, the way I look at it, their shareholders' equity, it's negative, but it's not really negative in that sense of deferred revenue. So I want to look now at the statement of cash flows. I'm going to share that on the screen with you right now. Check this out. What you see on the cash flows is, and I break this down into two screenshots. This one I'd like because it shows it 3 years in a row, running tally of 3 years. And I draw an arrow again, and you see what happened. There was something structurally that happened in 2018, something wacky, that the deferred revenue, it pops up, and it pops up in a big way, a big way. In 2018, that's where that 7.1 billion comes in of deferred revenue that then gets carried over as a liability on the balance sheet. But you can see from the cash flow statement in a sequence of events, it's interesting that popped up there. And by the way, what you see here is net cash provided by operating activities. Again, it was a weird year in 2018, but it looks like on an average year, like 2017, 2019, maybe they're bringing in $5 billion from operating activities. Let's just look at that versus their balance sheet. Let's look at it. And so I'm going to keep up cash flows for you, but I'm going to toggle back to their balance sheet on their liabilities. Long-term debt is $11 billion in 2019. And so in an ordinary year, they're bringing in net cash from operating activities of $5 billion. And if their long-term debt is $11 billion, again, they can through operating activities, they can basically afford that debt in 2 years' time. Is it a bad balance sheet or not? Personally, I dig a little deeper. It's not bad. And this is the problem that so many investors make, is they just look at something. Oh, someone told me shareholders' equity was important. Hey, it's negative. It's no good. You got to dig deeper into the numbers, and that's why I do what I do. And I'm not saying I'm perfect. I'm not a CPA. I bet you CPAs are watching. They're like, Ian, they're cringing. They're, Ian, you're not right, or this, or it's not perfect. But you know what? I am I imagine I'm probably mostly right here. Mostly right. And that's what matters, is digging deeper, challenging yourself, getting into the numbers to really figure out what's going on and not just looking at shareholders' equity. And so I want to move on now to check it out, the next screenshot. And what you see here is I'm going further down on the cash flows, and you can see they've been ramping up the purchases of common stock. In 2017, it was, this is again where my arrow is, 2 billion, 7 billion in 2018, 10 billion, $10 billion in 2019. And you can see, oh, their cash is down. We saw that from the assets. Why is their cash down? They're buying back stock. They're buying back stock. Now, their debt's also up a little bit, so perhaps they're taking on a little debt too to buy back stock. If I had a pet peeve with this company, it would be that they bought back way too much stock in 2019 and 2018. I wish they didn't. That being said, look, interest rates are low. They did have cash on hand. Now they don't have as much, but they did have cash on hand. They used it to buy back stock. Quite frankly, they didn't know the pandemic was coming. I think if they did, they wouldn't have gone so aggressive. That's probably one of the reasons the stock is down. Stock is down right now. It would have been nice if they had conserved more cash before the pandemic. They didn't know. And so, yeah, it's not perfect. I have a pet peeve that they bought back so much stock, but I think they generally did it right. It looks like they generally used cash to do so. And so I think that there are pros and cons with any company, but you see here a trend towards purchasing back massive stock. And if there was one thing I wish these companies would do is wait till the stock is way down, wait till it's way down, and go heavy then. 2019, the stock was not, generally speaking, that cheap. That being said, by understanding, and again, this is only through 2019, when we look at the full year of 2020, I do recall that they authorized some share buybacks this year as well. And so hopefully they got some good buybacks this year in 2020 as well, when the stock price was cheaper. And that, I'd say, actually is one thing they did do right. I guess they did wrong that they probably went too heavy at the high prices in 2019, but at least they didn't give up in 2020. My understanding is they're continuing the buybacks in 2020. So that's something they're doing right. But again, to summarize, I'm going to share on the screen with you all right now. I have a summary of all this stuff as it pertains to my deep dive in StarBucks. And basically what I found is, don't jump on this bandwagon of shareholders' equity. Maybe do it for bank stocks, but not for other stocks. Other industries require further analysis, further deep dive. And what I found is that the cash is down by about $6 billion. They had massive buybacks that keep growing each year. I found about $8 billion deferred revenue carried as a liability. This alone skews their shareholders' equity. This started in 2018 and hurts them on the balance sheet a big way in 2019. But is it a real liability or not? Or is it something that's actually good for the company? And as mentioned, I have a critique of the buybacks. Now, as long as we're on the topic of balance sheets, I'm going to share something else with you on the screen right now. This is something I read in the footnotes from the annual report from StarBucks. And what it says here is, this is something about their property, plant, and equipment. And it says this includes assets under capital leases. They're carried at cost. That's all I want to do. Less accumulated depreciation. So they are carrying their property, their plants, their stores, their leases at cost. And so you might say shareholders' equity is negative. The assets that they have, my take at least, is they're probably worth more than what they paid for them. They're stores that have been leased, that have been renovated, that are operating businesses. Are they really just worth the money they put into them? Or was something greater than that created? Was there value creation? They wouldn't be in business if they weren't creating value, but it just so happens the way they do their accounting, and this is probably dictated by GAAP accounting rules if I had to guess, is they're carrying it at cost. And so another reason that assets, quite frankly, may be more depressed than they otherwise would be. And so you start looking, shareholders' equity is negative, but is it really negative? They're carrying their property, plants, and equipment at cost. And so something really, really important to note. All right, everyone. that's Starbucks. I want to move on to the third stock that I am buying right now in June and July of 2020. So check it out. I'll share it on the screen right now. And this is my old friend 3M company. And so I'm excited to talk about 3M here for a little bit. Last trade I made for 3M was actually today. The market was down a bit, and on the big down days, I take the opportunity to buy stock. It's always good to buy when it's down, in my humble opinion. I feel good buying value, and 3M was at $151.98 today. I bought it at a starting yield of 3.87. Again, in this interest rate environment, in this environment of economic stimulus, how often is it that someone can find a company of the caliber of 3M at that type of starting yield? Very rare. And so I love buying it at these prices. The forward PE on this one is an 18.74 for 2020 and a 17 for 2021. Out of the three stocks, this one is in value territory the most. And so I like that. The payout ratio is really solid. It's a 73% this year, 66% next year. And they meet the marks on dividend growth, 7.5% 5-year compound annual growth rate on average of the dividend, which is a fundamental golden rule for me for dividend investing. And so all great things to like. But what else do I like about them? It is on the right-hand side of the screen. I like that it's a diversified industrial company, and I generally have lower exposure to industrials. I like that my allocation is so low at a 2.58, and I need to get it up to a 5% or more. So I have a long way to go. It may look a little daunting, but it is brick by brick. I like it that they have a science focus. This is a scientific research company. They are the solution to the pandemic with their masks and respirators. And I love it that they do more business internationally than domestically here in the United States. And so it gives me that well-rounded exposure. And so I'm so happy to be buying 3M because it's just so diversified. And when you think about what I'm doing here, what I'm buying right now in June and July of 2020, and you kind of tie it all together, I'm going to share on the screen with you right now a summary of everything. And what you see is I'm buying three companies in three different industries. And if I were hypothetically starting out right now, I would be comfortable just buying these three, having a portfolio of just these three stocks, because they all are so different and so unique, yet they are all such amazing winners in their respective categories. I'm paying up for quality. I am really focused on dividend growth. They meet the marks. I'm focused on core ride or die stocks. I'm focused on stocks that are underallocated. I'm bringing them to size in my portfolio. All of these, quite frankly, have a technology focus, some more than others. These are all three companies have a science or technology initiative. I mean, 3M, that's all they're about, but Starbucks, payment processing, PepsiCo, direct-to-consumer website initiative. And it's my belief that, look, technology is here to stay. Companies are either going to innovate or they're not going to make it. And so it's exciting to be doubling down on three stocks right now that are really, really innovating. They have sustainable payout ratios, although Starbucks is wacky this year because they are really hurt by the pandemic. They're geographically diverse, and these are all three iconic brands. And so that's what I'm buying right now. I reserve the right, obviously, to buy other stocks as well, but those are the three that are top of mind. Share in the comments below the top three stocks you're buying right now. Let's come together as a community and share all of our best ideas. That is what makes this community, PPCE and dividend investing for everyone, so special. I love you all. The best way you can thank me is by liking this video. Please hit the thumbs up button, subscribing, commenting. All of that means the world to me. If you do subscribe, don't forget to hit that little notification bell as well. It means the world to me. All of that support encourages me to produce content like this. If you want to go above and beyond, check out my merch. I am selling custom merch, custom to PPCE, and this is one of my favorite items, by the way. Your purchase greatly supports this channel, and you will look so fly in your custom dividend investing merch. All right, everyone, before I go today, in terms of a full disclosure, I am long all three stocks mentioned today. I am long PepsiCo, ticker symbol PEP, Starbucks, ticker symbol SBUX, and 3M, ticker symbol MMM. I own all three of those stocks in my personal dividend stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. I'm just here sharing my journey on YouTube for fun and entertainment. Investing carries tremendous, tremendous risk. All right, everyone, don't forget to subscribe, like the video. I love you all. We are 60,000 strong. I'll see you in the next video.